Toys R Us didn't collapse because people stopped buying toys. It collapsed because debt made adaptation impossible. This is the story most people miss, lost in the simpler narrative of online disruption, changing consumer habits. The truth is far more structural and far more instructive. The company was not a dinosaur oblivious to the coming meteor. It was a powerful beast, caught in a financial trap of its own making, a trap that slowly squeezed its ability to move, to innovate, to survive. Its failure was a quiet, slow-motion catastrophe orchestrated not on the sales floor, but on the balance sheet. For decades, Toys R Us was more than just a retailer. It was a cultural institution, the undisputed category killer in the toy industry. At its zenith in the 1990s, the company ran 1,400 plus stores worldwide. It commanded a dominant market share and revenues in the billions. Visual call-out. Market share peak and then a slow, steady decline. Its big box format, endless aisles, stacked high with every imaginable toy. Parents went there because it had everything. Kids went there because it was a wonderland. The iconic Geoffrey the Giraffe logo was a globally recognized symbol. The company's position looked unassailable. The illusion of invincibility was powerful. The company was a cash-generating machine, a must-have account for every major toy manufacturer. Hasbro, Mattel. Its sheer scale gave it immense purchasing power and influence. To many observers, the business model appeared robust and enduring. Demand for toys was perennial, and TRU was the primary destination. It was easy to believe the company would keep adapting. But here's where it became dangerous. In 2005, a consortium took Toys R Us private, KKR, Bain Capital, Vornado Realty Trust. Headline: $6.6 billion leveraged buyout. Buyers saddled Toys R Us with over $5 billion in new debt. Suddenly, the company wasn't just selling toys. It was servicing an enormous financial obligation. Hundreds of millions in cash flow that could have funded adaptation were legally required to go toward interest payments year after year. This reality was hidden from the average customer, who still saw brightly lit stores and full shelves. The company's size and brand recognition masked the underlying financial fragility. Competitor Amazon, competitor Walmart, competitor Target. These rivals were aggressively investing in e-commerce, supply chain logistics, and in-store experiences. Toys R Us was treading water while the market moved fast. The debt acted like a ball and chain, preventing the giant from moving with agility. The problem was no longer about selling toys. It was about the crushing, invisible weight of the balance sheet. To understand the mechanics of the company's paralysis, we need a tool. Let's call it the debt rigidity score. This isn't a metric you'll find in a standard accounting textbook, but it's a concept that gets to the heart of the matter. It is a simple diagnostic that measures how much a company's fixed financial commitments prevent it from adapting to change. A high score means the company is brittle, locked into its current path, unable to pivot, unable to invest, unable to compete effectively when market conditions shift. The debt rigidity score is composed of three distinct yet interconnected parts. The first component of our score is the debt service burden ratio. This is defined simply: total annual debt payments, principal, interest, divided by the company's annual operating cash flow. This ratio tells you exactly what percentage of the cash generated from the core business is immediately diverted to pay bankers and bondholders. A high ratio is a glaring red flag. It indicates the company has very little discretionary cash to fund operations, let alone the future. It's the financial equivalent of trying to run a marathon while breathing through a thin straw. The body is working, but it's being systematically deprived of the oxygen it needs. For Toys R Us, this ratio was catastrophically high following the 2005 leveraged buyout. The company was now responsible for servicing over $5 billion in debt, which translated into annual interest payments that often exceeded $400 million. In many years, this figure consumed nearly all, and sometimes more than all, of the company's operating profit. Think about that. Almost every dollar earned from selling dolls, board games, bicycles was not available to improve the business. It was instead transferred directly to lenders. This created a vicious cycle. Poor performance, driven by a lack of investment, made it even harder to generate the cash needed to service the debt. The most critical warning signal they ignored was the persistent starvation of their e-commerce technology budgets. While Amazon, Walmart were pouring billions into building world-class digital platforms and logistics networks, Toys R Us was making token investments. In the early 2000s, it had even outsourced its entire online operation to Amazon, a strategic blunder of epic proportions that effectively trained its customers to shop elsewhere. Dimension 2, the capital allocation constraint. We can measure it as capital available for reinvestment, CapEx, as a percentage of total revenue. This metric shines a light on how much a company is investing in its future. When this number dwindles, the business begins to eat itself, failing to stay relevant and efficient. At Toys R Us, the constraint became severe. Hundreds of millions went to debt payments. Very little remained for CapEx. Reinvestment rates fell to dangerously low levels, far below competitors. While Target and Walmart were remodeling stores, integrating physical and digital operations, optimizing supply chains, Toys R Us stores looked dated and worn. Carpets were old, the lighting was dim, in-store tech was virtually non-existent. The visible deterioration of the customer experience was the ignored warning signal. These were not isolated hiccups. They were a decade of underinvestment made physical. They couldn't afford renovations, and tech upgrades needed to compete with rivals' clean environments, efficient operations, integrated online and offline experiences. Customers expected a seamless experience, modern, engaging environments, competitive prices. Unable to invest, Toys R Us lost its value proposition. It was simply the one with the most debt. The Fixed Commitment Rigidity Index. This concept measures the weight of a company's non-debt fixed obligations, primarily long-term operating leases, relative to its operational flexibility. For a big box retailer like Toys R Us, this was a massive and ultimately fatal issue. The business model was built on thousands of large, expensive physical stores, each locked into leases that often spanned a decade or more. These lease payments were non-negotiable fixed costs, much like debt payments. When the retail landscape shifted toward e-commerce and smaller format stores, Toys R Us was stuck with a vast and costly real estate portfolio it couldn't easily shed. This high level of fixed commitment created immense operational rigidity. The company couldn't simply close underperforming stores without incurring huge penalties for breaking the leases. It couldn't pivot to a more flexible, smaller footprint model because it was legally and financially bound to its legacy of massive warehouse-style locations. Even as foot traffic declined and sales moved online, the company was still forced to pay premium rent for millions of square feet of unproductive retail space. This index shows how inflexible real estate strategy can be as much of a financial trap as corporate debt. The clear warning signal was the growing mismatch between its physical footprint and shifting consumer behavior. For years, analysts warned the big box model was under threat. Shoppers used stores as showrooms before buying online or forwent the trip altogether. Yet Toys R Us remained locked into its sprawling, expensive real estate. The inability to quickly cut store count and reduce leases showed the company lacked structural agility. It was fighting a new war with an old map. The consequence was an unsustainable cost base that made profitability impossible. Combined with heavy debt service, the fixed lease obligations created a financial vice. Revenue declined due to online competition, while fixed costs stayed stubbornly high. There was no room to maneuver. The company couldn't lower prices to compete because margins were crushed by fixed costs. The confluence of these three rigidities, a high debt service burden, a severe capital allocation constraint, an inflexible fixed commitment index, created a perfect storm. The turning point wasn't a single event. It was a gradual realization by the market, by suppliers, by creditors, that the structure was broken. By the mid-2010s, the writing was on the wall. Sales kept sliding, massive interest and lease payments remained, consuming cash and blocking any turnaround. The company was running just to stand still. The market response was swift and brutal. Suppliers grew nervous. Toy manufacturers, once reliant on Toys R Us, began demanding stricter payment terms or cash on delivery. Credit agencies downgraded the debt to junk. Refinancing became impossible. The company fell into a death spiral. In a last-ditch effort for the 2017 holidays, Toys R Us filed Chapter 11 in September 2017, aiming to restructure massive debt. The holiday season failed to rescue them. Sales were weaker than expected, and necessary financing didn't materialize. In March 2018, they announced U.S. liquidation, closing all stores and laying off approximately 30,000 employees. It was a slow, predictable collapse from financial strangulation, and the primary author of that fate was not Amazon. It was the debt itself. What early signal do you think they ignored? Your personal resilience shield, calculating your score. The story of Toys R Us is more than a business case study. It's a powerful metaphor for personal finance. The same principles of rigidity and agility apply to your own balance sheet. A financial life overloaded with fixed commitments is brittle and vulnerable to shocks, just like the company was. To gauge your own vulnerability, you can calculate a personal debt rigidity score. This simple exercise can reveal hidden risks in your financial structure and provide a clear, objective measure of your ability to navigate unexpected change, job loss, medical emergency, sudden economic downturn. Here is how you calculate your score. First, add up all of your fixed, non-discretionary monthly obligations. Mortgage, rent, car payments, student loans, minimum credit card payments, other recurring bills or subscriptions that are difficult to cancel or change in the short term. Do not include variable spending like groceries, gas, entertainment. Next, divide this total by your net monthly income, your take-home pay after taxes. The resulting percentage is your personal debt rigidity score. You can use the following thresholds to interpret your result. A score under 50% indicates a stable and flexible financial position. A score between 50% and 65% signals moderate rigidity. A score over 65% represents high rigidity. A high score means you have very little control over your cash flow. This score forces you to ask more structural questions about your finances. Most people focus on interest rates, whether they can afford the monthly payment. The more important question is, how much does this fixed commitment reduce my ability to pivot? If my income were to drop by 20% tomorrow, would I still have options? Or Would my financial life break? Thinking in these terms, assessing your agility rather than just your solvency, is the first step toward building genuine, lasting financial resilience. It shifts the focus from merely surviving to being structured to thrive. The 30, 60, 90-day plan, building structural agility. Calculating your score is the diagnosis. Now comes the treatment. This is your 3-step resilience shield. The first step is to reduce non-essential fixed costs. Identify every recurring charge. Cancel unused or underutilized subscriptions. Call your cell phone providers, internet providers, insurance providers to negotiate a lower rate. Aim for a quick 5 to 10% reduction. This immediately frees up cash flow and creates breathing room. The second step is to accelerate high-interest debt payoff. Consider consolidating multiple high-interest debts into a single lower-rate loan if it improves your terms and cash flow. The objective is to systematically eliminate the obligations that are costing you the most and locking up your income. The third step is to increase liquidity. Cash is the ultimate shock absorber. Automate weekly or monthly transfers into a dedicated high-yield savings account. Build an emergency fund that covers 6 to 12 months of essential expenses. A 9-month buffer is a strong target. Toys R Us didn't collapse from competition alone. It collapsed because debt restricted its ability to pivot. Debt reduces agility. Now evaluate your debt rigidity score, team. Total fixed obligations, net income. If more than 65% of income is fixed, your flexibility shrinks. Debt isn't dangerous because it exists. Debt is dangerous when it eliminates your ability to adapt. Ask, how much does this debt reduce my maneuverability? If my income dropped 20%, could I still pivot? Here's how you stabilize. 1. Reduce non-essential fixed costs. 2. Accelerate high-interest debt payoff. 3. Increase liquidity buffer to 9 months. 30 days, diagnose exposure. 60 days, structural adjustment. 90 days, risk diversification. Collapse is rarely sudden. It's structural. If you value structured thinking over surface-level advice, this channel is built for you. Resilience isn't about size, it's about structure. In the next corporate risk autopsy, we examine Apple and the strategic focus reset,